Before we can talk about interest rate swaps, we need to understand interest rates. It's also a commonly misunderstood topic which causes many people to make poor financial decisions. One of my main goals in this channel is to promote financial literacy. So, what is an interest rate? People broadly fall into two categories: they are either borrowers or savers. Borrowers need access to money now and are willing to pay a price for immediate access to funds. Savers have excess cash and are willing to set aside their money if they are able to earn a sufficient return on their investment. The rate paid by borrowers and earned by savers should theoretically be the same rate. This rate of return is called an interest rate. We all have some familiarity with this in our daily lives when we take out a mortgage to purchase a home or when we fund a savings account. The amount lent or borrowed is expressed as a percent of the principal amount. You can think of the principal as the amount that you need to borrow if it's a mortgage or the amount you are setting aside in a savings account. Interest rates are quoted in a variety of ways, but we need a common way to express them to be able to compare them. An annual interest rate or APR is the interest rate on a loan expressed over 1 year factoring in fees and commissions, but without considering the impact of reinvesting the money, also known as compounding. For example, suppose we borrow $1,000 at an interest rate of 1% per month and there are no fees or commissions. The APR would be 1% times 12 months, which is 12%. Now, suppose we borrow $1,000 at an interest rate of 4% per quarter, or 3 months. The APR would be 4% per quarter times 4 quarters per year, which is 16%. Clearly, the interest rate in the first example is less and we would prefer to go with that interest rate if we were a borrower. You may have also heard of the term annual percentage yield, or APY. The APY is used by many banks to specify the interest rate offered on different products like savings accounts and certificates of deposit, CDs. The difference between APR and APY is that APY includes the impact of compounding. Compounding can be understood as interest earned on interest. Let's go back to the first example and see what the equivalent APY would be for an interest rate of 1% per month. On our initial investment of $1,000, the bank collects 1% or $10 of interest after the first month. Assuming interest rates don't change, the bank could then go and reinvest that $10 at the same 1% interest rate, which would earn 10 cents after a month. Interest on interest would be earned at each month. We can calculate the APY of a 1% monthly interest rate as follows. As you can see, the APY would be 12.68% for this example, which is slightly higher than the 12% simple interest we calculated earlier. There is not necessarily a preference to use APR or APY. You just need to be aware that interest rates can be quoted in different ways depending on the product. Why do interest rates matter to you? Borrowing is a quintessential part of life, whether we are borrowing cash, property, or financial securities. The interest rate determines the amount of interest we must pay to borrow, and therefore, interest quantifies the cost of borrowing money. An interest rate that is higher makes it more expensive to borrow the same amount of money than a low interest rate. Interest rates matter for the wider economy because businesses and corporations must borrow money to finance projects and to expand their operations. If it is more expensive to borrow money, then businesses may reconsider their operational plans and may put off purchasing assets such as land or factories. How are interest rates set? Interest rates are set based on several factors, including the overall health of the economy. In the United States, the Federal Reserve establishes the interest rate, and this is used by banks to determine their APRs. A higher rate set by the Fed means that banks will have to increase the cost of debt to customers. This causes downstream impacts to the economy because it disincentivizes people from borrowing. Interest rates tend to increase as inflation increases. To fight inflation, the Fed increases interest rates, which hurts the economy but helps to bring down the costs of goods and services. On the flip side, the economy tends to soar during periods of low interest rates. You are now ready to understand interest rate swaps. I hope you found this video helpful. If you enjoy this content, please consider liking this video and subscribing to this channel.